Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'm Kevin Hincks. I have two paper money trades for you today on two high-profile names that we're looking at. First is Google Alphabet, and the second one is Boeing, in the news a lot this week with discussions about the 747 and Air Force One and and Elon Musk getting involved in Boeing. So we'll look at those two names today. Let's get right to it, though. First, Google Alphabet. Now, if you look at the chart of Google Alphabet, since hitting a high of 207.5, it's sold off. That date was on the 3rd of February. It's down in the last month. It's down 7.5% off its recent highs. So if you look at the last week, 1.4% lower. So Google Alphabet, we're going to look at something. It currently sits around $183. Let's get right to our trade. The paper money trade we looked at here is something in the calendar spread family. That's just going out to the March 21st expiration, which gives you basically a month of duration on the long side of this trade, which we'll talk about. It will allow you to extend duration on the short side of the trade. Buying the 190 call, just 5.5, well, now $6 and change higher than where we are now. Buying the 190 call on the March 21st, selling the February 28th 190 call. We put that in at about $2.30, probably trading $2.15 now, a little lower as the stock is guided lower with the rest of the market. Now, this is different than a diagonal spread, as you can see. Why? It's in the calendar spread, but it's the same strike. There's the telltale difference between a calendar spread and a diagonal spread. Diagonal has a either short or long vertical embedded in that trade. The calendar spread, same strike. So a 190 call calendar in Google Alphabet. The risk on this trade, whatever the debit you pay, that's the risk on the trade. Now, because it's a 3-week trade, right, March 21st to February 28th, you will have chances to extend duration and chip away at that net debit. Remember, when you chip away at the net debit, you also chip away at the break-even price on that trade. But always, in a calendar spread, the risk is the debit paid. That's the most you can risk on this trade, is the debit paid, whatever that is. Is it 230? Is it closer to 215 or 210? Whatever it is, that's the risk. All right, let's get to our second trade, and that is Boeing. Now, Boeing has had a nice, kind of the opposite of Google Alphabet, as in the last month, it's up 5%. Last 3 months, up 27.5%, as slowly but surely this company continues to make a comeback. It's now through its 200-day moving average, through its 50-day moving average on the upside. Down today, though, as news, pressure from the Trump administration about Air Force One comes out, and overall weakness in the market and in this name. So that one, we'll look at something a little different. We'll go back to the call diagonal, not the call calendar. We'll buy the March 14th, going out not quite as far as the March 21st, only 22 days, so 3 weeks. Buying the 185 call, which is just slightly out of the money in terms of Boeing. Buying the 185 call in March 14th, and then selling next week's February 28th 192.5 call. How did I come to that number? Well, look at the move for next week. About $7.50. Now, can you do the 190? Yes, you can. But the stock was a little bit higher when we put this trade in, so the 192. You can adjust that strike in line with that right column expected move for the week, up or down. So in this case, the call diagonal, 185, 192.5. The debit we put it in at is about 480, trading about 435 right now, 440 in that range, because the overall market has sold off. Boeing has sold off with that, so you're getting that long deltas of about 32 long deltas, less than it was a half hour or 45 minutes ago. So again, similarities to the calendar spread. You're buying longer dated, you're selling shorter dated. Unique to the diagonal spread is the vertical spread embedded in there. In this case, 185, 192 vertical spread embedded. The trade-off is you're going to pay more. right? The debit here is about $4 and, well, 20 cents. We had it in a little higher. It's now trading about $4.20. Again, similarities, that's the risk on this trade. And you will have an opportunity to extend duration on this trade by buying in the short 192.5 and extending duration on that trade, thus chipping away at that net debit. So 2 trades, one more passively bullish in Google Alphabet, one more aggressively bullish in Boeing. That's our show for today, everyone. Have a great day. We'll see you tomorrow with another edition of The Daily Trader. I'm Kevin Hincks.